Welcome to Wall Street Unspun with your host, Peter Schiff.
But it's a giant bubble in search of a pin, and it's going to find one.
Are you confused with the ups and downs of the economy and what it means to you?
Don't believe the propaganda, and that's what it is. When you're listening to an analyst on a lot of these popular financial shows, you're not getting investment advice. You're getting propaganda.
Get ready to untangle the web of misinformation provided by the mainstream media.
These firms are trying to sell you stocks. Their real clients, their banking clients, are trying to get rid of stock.
And now, here's your host of Wall Street Unspun, the president of Euro Pacific Capital and a licensed broker with a passion for truth. It's Wall Street Unspun with Peter Schiff.
Hello, everybody. It's Andrew Schiff calling in from New York City. I'll be hosting for Peter Schiff today. As you can imagine, this is Andrew Schiff, by the way, Peter's younger brother, a broker in the New York City office, also director of communications for the firm. You may have seen me on television now and again. I was on Fox Business last week, and I've been on CNBC a couple times. You may have recognized my face. But anyway, as you can imagine, that Peter is under increasing demand from his political career. We're getting more and more substitute hosts for Wall Street Unspun. Peter, I really think he's heroic in his desire to do these shows. I mean, last week he called in from Florida. He was visiting our mother, and his plane was 4 hours late. He was hoping to do the show from her house, and he was still in the car going to her house when it was 8 o'clock time to do the show. And he was frantic. He called me, and I said, Peter, don't worry about it. You know, no one's going to care. It's the Wednesday before Thanksgiving. No one's listening in. But he did it anyway. I haven't heard the show, but I hope he did it with some quality. So as much as he can, and he probably goes above and beyond. But as a political animal, I'm sure you must be aware that he can't do it every Wednesday. Tonight he's going to a political charity dinner in Connecticut, and he has to be there. So he asked me to do it, and of course, I'm fine with doing that, and I hope you're fine with that as well. So let's get into it. And obviously the big item of the day and dominating the financial airwaves more than any other story that I can see since probably the TARP was introduced is the run of gold. Gold broke through $1,200 an ounce. Well, actually it broke through yesterday, but it added another $10 or so today, closing at around $1,220 an ounce. Just an amazing move. Now, I always said, and I think Peter said as well, that when gold broke through the $1,000 barrier decisively, which didn't really happen until about 2 months ago or 6 weeks ago, it flirted with $1,000 an ounce a couple of times. Once in 2008, I think once earlier in 2009, about 6 months ago. But these were very quick moves. They hit the $1,000 barrier, and they sold off at least 10%. So there was a couple of tries, kind of like a fly, kind of flying up to the ceiling and bouncing off. You've seen that at home. But when it broke through, I thought it would certainly take away that psychological barrier and really put the sellers in charge. And that's been the case. I mean, it's rocketed up, and the moves have been spectacular. People are saying, and it is getting a little bit worrisome. And Peter was on CNBC talking about that today. It seems like more and more people are getting into the rally, and it's true. More fund managers are getting in. You see people who were formerly completely dismissed any gold strategy as a portion of the portfolio are now more amenable to it. So clearly there are more buyers now, and you got to think, well, if there's more buyers, that means the party's already over, and the next move is going to be down. And we don't think that. We certainly are watching the fundamentals. And the fundamentals for gold are still very good. And I'll get into that in a second. But the question is it getting a little frothy? We never think that it's going to go in a straight line. I mean, I think there's going to be a pullback. Gold will sell off, probably take $100 off an ounce at some point, 150, 200, who knows? It could go back down to 1,000. So the old ceiling is now the new floor. It could. I don't think it will. The fundamentals are still there pushing it up. But there could be a pullback. But we do think that as long as the fundamentals in the world don't change, and there's not any real likelihood of that changing, that the pressure will still be on the upside. Central banks are getting leery, outside of the United States, getting leery about their dollar holdings. There's no alternative necessarily to dollar holdings. The IMF drawing rights basket is kind of a fantasy. No one really has a lot of faith in the euro. The Chinese RMB is still controlled by fickle political motives in China. So this basket of currency approach is questionable. So people are going for a basket made of gold, so to speak, by adding to their dollar reserves, their gold reserves. They have that kind of money, hard money they can use in any kind of currency scenario. So central banks are net buyers, not sellers, for years and years through coordinated action. Central banks periodically took the wind out of gold sales by selling into a frothy market. That was a coordinated strategy for many years. That seems to be breaking down. Russia's buying gold. China's buying gold. India, of course, most visibly is buying gold. Now individuals are buying gold. Hedge funds are buying gold. Mutual funds are buying gold. And they're not making any more of it than they made in the past, maybe a little bit more. Peter did give me a little bit of schooling when I was on Fox Business. I was kind of surprised by a question where they said, well, yeah, but isn't it, as in percentage terms, the percentage of what it costs to mine gold versus what it's worth, isn't that kind of moving down? And although that is true, because energy costs have come down a little bit because, versus, say, last year, while that's somewhat true, the real thing is, the point that I missed was that, yes, the costs are fairly low to mine gold relative to the price of gold if you have the gold in the ground and you have identified where it is. Finding gold is very difficult. So if you have a proven gold mine and you know the gold's in the ground, then to dig it up and make gold out of it and then sell it into the market, you can get a flatter margin than you could, a year or two ago, which is great news if you're a gold producer. But if you don't have the gold and you got to go out and look for it, it's becoming more and more difficult to find as more and more of the Earth's gold has been used. So the costs of going out and exploring are still very high. So when you try to factor in the cost of finding and producing gold, it's a different story. So that leads me into the next part of the question of the discussion, which is, of course, the gold miners, which are all doing very, very well. We've seen a tremendous run in gold miners. Yesterday, I think the GDX index, which is an index of gold mining firms around the world, was up around 4.5%. It tacked on another 2% today. So when gold goes up 2%, these stocks are going up even more. So our clients with exposure to mining stocks are doing very, very well. And it's nice to see that. It's been going on for a while, but now the gains are becoming even oversized and very, very easy to see. But just a little perspective on gold's move, which I think is nice to have. And by the way, Peter was on CNBC today, and it was very interesting. We dug up he was on with Mark Haynes, who hosts Squawk on the Street, and Peter recalled that in 2005, actually November 2005, 4 years ago, he was on the same show with Mark Haynes. They got into a little back and forth about gold. And at that point, I think gold was $4.75 an ounce, and the Dow was somewhere around 11,500, or closer to 12,000. And Haynes was saying, "Who cares about gold? You gold bugs come out here. Gold's a terrible investment. I don't care about the price of gold. Our investors shouldn't care about the price of gold." And kind of gave Peter a hard time. So we dug up that clip and we sent it to the producers, saying, "Hey, wouldn't this be fun to show this clip right before Peter and Mark talk about gold?" I guess we thought it would be really, really fun. I don't think they necessarily thought it would be really, really fun, because they didn't. So they didn't show the clip. Peter mentioned it, and Mark was like, "Oh, here it comes. You were right." But just as a little bit of a history lesson, since that time, 4 years ago, gold is up about 163%. I did the math, whereas the S&P 500 is down 6%. So that's I guess maybe Mark should have cared about gold. But just making the time frame a little narrower, over the past year, gold is up 52%. Nice year. I mean, just to preface this, everyone's talked about how 2009 has been a gangbuster year for stocks, and it has. I mean, there's no question about it. That 2009 has been one of the best years for stocks ever, mostly because 2008 was so horrific. We know that as international investors better than anybody because the gains seen overseas have been tremendous, and not even discussing factoring in the currency moves. But the U.S. stocks in 2009 were up 30%. Pretty good year, no question about it. Gold was up 50%, and silver was up 98%, which is, silver was closing the gap, and it's still historically valued much lower than it has in a ratio to gold. So it's got a lot of ground to make up, and it has made up that ground. And, of course, silver's got a little bit more of a industrial element to it than gold, which is viewed more as money. But silver, we still think is a great investment, So this is still the year of gold, and that should be when they write the year-end wrap-up stories, 2009. Gold should be the top story. But the question is it a bubble? A lot of people are starting to think it's a bubble. A lot of people are calling maybe they're saying it goes to 1,500, but beware. Look what happened in 1980. Gold spiked up to $840 an ounce, and then it came back down to $200 an ounce, or to $50 an ounce a few years later, and stayed there for about 10 years. So they're saying that can happen again. Watch out. This is getting frothy. This is looking like Pets.com. It's looking like the tulip craze. And we think that's all bunk. I mean, when you look at none of those other crazes had any real solid fundamentals. A tulip was worth nothing because it had no value, and you could make them, you could breed them easily. Tech stocks had no value, clearly. The surge in gold in 1980 was certainly an aberration. When you looked at where gold went from the beginning of that decade, 1972, gold was still at $35 an ounce. So it went up 200 times before the peak. I mean, the move was so enormous that it certainly got very frothy. And if you look at the chart on gold, you can see this very, very clear death-defying spike, 1979, 1980. Of course, inflation at that point was incredibly obvious to everybody. So that was certainly the move, and we were dealing with double-digit inflation. When Volcker came in and broke the back of inflation, and that started coming back into earth, all of a sudden that gold market came to a pretty rapid halt, and gold prices came way back down. Now, I think right now, first of all, we have plenty of inflation, although none of it is in plain sight. So unlike 1980, where everybody knows there's been inflation, right now no one really thinks there's inflation, or no one really sees the inflation, and gold's rallying anyway. So imagine what's going to happen when that inflation comes into plain view. And to say, also, if you look at that spike, first of all, gold went from 35 to 200 to 800. In this whole move, going back to 2001, gold goes from 250 to 1,200, so it increases 5 times. Nowhere near that kind of magnitude. Plus, it has been very relatively ordered. And if you look at the chart on gold, you'll see a pretty strong base, and not what you would call a spike. So there's a lot of reasons to believe that technically, when we're still not at the end stages of a frothy rally. And then when you look at the fundamentals, why are people buying gold? What's going to make that change? And when you realize there's no end in sight for dollar debasement, no end in sight. The Chinese are stubbornly refusing. I mean, the Europeans just came back with a mini summit meeting from China, and they were very disappointed at the Chinese government's unwillingness to even discuss relaxation or of the RMB and to let it rise. So that's kind of a big head scratcher. We don't understand it. But if they want to maintain their currency peg, they're going to have to inflate their own currency just as fast as we're inflating ours. So when you think about that, then you realize that the move in gold is real and is going to last. Now, certainly, benchmarks. Peter made a statement about $5,000 an ounce gold. That got a lot of attention. People want to get him on the record. They want to say exactly when is that going to happen. We don't have a crystal ball, but certainly $5,000 is reasonable. Not right away, not this year, next year, but certainly possible. And it wouldn't surprise anybody if we got there within the next few years. In terms of this current move, we're going on the record by saying we think $2,000 an ounce is certainly possible in 2010, and $2,300 an ounce, which would be the inflation-adjusted high for gold, which was reached in 1980, would be certainly possible. Now, maybe it goes to that level and pulls back like to 1,500, gets 60. Who knows? But there's going to be some volatility. But until the fundamental situation is changed and the dollar debasement stops, then gold is priced in something else. Then the price is going to continue to go up. Which actually leads me to another point. I read a very interesting op-ed piece in the Financial Times that I wanted to mention. It was written by it was this week, or this Monday or Tuesday, Monday, I believe, by a Yale professor named Jeffrey Garten, who wrote a little piece buried in the bottom of the FT. It's not something that a lot of people would have seen because it's way at the bottom of the page on the op-ed page. We must get ready for a weak dollar world. That's the name of the article. And he basically says, look, everyone's got to understand. It's like everyone's in denial. We've got to understand that the dollar has to be weaker for a variety of reasons. And when you look at it, yes, a weak dollar, unfortunately, is the cure to many, many of the ills that are currently affecting the global economy. The weak dollar, the strong dollar is a relatively strong dollar is the effects of distortions that are being put through not only by our huge deficits and our ability to finance those deficits from overseas, but our having access to capital from overseas, Chinese giving us our savings for us to borrow against, and and the U.S. continuing to run these huge deficits, and that creates these distortions. Now, the distortions would all go away if the natural physical consequences of those distortions were allowed to play out, meaning the dollar were lower. Now, that would be a very bad thing for Americans because Americans would be poorer. We wouldn't be able to buy as much. We would have to accept lower living standards. Our wages wouldn't go as far. We would be outbid by foreigners for many of the things that we make and the things that they make. And we would simply not be able to fly as much, not be able to buy as many cars and buy as many things and shop as much and do all the things that we like to do when we have to get by with smaller houses, more modest vacations. You name it. We'd look more like other countries. We'd look more like, I hate to say it, but, Mexico maybe, but we look more like, a much poorer United States. I don't want to, point to one country in particular, but we wouldn't have the money we have now, or the purchasing power that we have now. We'd have the dollars, but not the purchasing power. So he was saying, look, we got to realize this, and we got two choices. Either we manage the descent in a kind of coordinated way, and he was hoping that if these meetings aren't already happening, but secret meetings, quote unquote, were happening between U.S. authorities and international counterparts to manage a process of dollar debasement or dollar devaluation, or we're going to pretend it shouldn't really happen, and then it's just going to happen by itself until the point where normal structures where the central banks can't control the movements anymore, and then it'll happen of its own accord, and that's much more dangerous because it'll be violent and it'll be quick. So he was saying, look, we just got to get on top of it, and everyone's got to admit where we're going, and we just got to come up with chart an orderly course. I don't know if that's possible, but I thought it made some degree of sense. Anyway, the guy's name was Jeffrey Garten. I wanted to go through a couple other pieces of news through the day. I thought were pretty interesting. First of all, the big news is that the B of A is repaying their TARP money, $45 billion, which they're happy to do because it gets them off under the thumb of Barney Frank, and no one wants to be there. But I think it's interesting that they're able to do it, and they're doing about half of it on the basis of a new equity float. So they're issuing more stock, and they're pinning on the backs of their shareholders because if you issue new stock, of course, it's dilutive of existing shareholders. But it raises some interesting points about being too big to fail. Of course, without the TARP money last year, most likely that B of A would have failed. And if they had, then we wouldn't be at this point. We wouldn't be able to repay $45 billion. But it's interesting to understand that, one of the reasons they didn't fail is because they own lots of bad debt by AIG and other companies. So they invested and they bought a lot of Fannie and Freddie debt. They made bad decisions, and they didn't have to pay for those decisions. Now it's clear that B of A is too big to fail. It's one of these companies that's too big to fail. So they know that whatever they do in the future, they're going to get bailed out. So they're taking a lot of risks now, and the risks are paying off because the markets are going up. They're making a lot of money. All Wall Street firms are making a lot of money. It's very hard not to make a lot of money when all asset classes are going up. And believe me, all asset classes are going up. So they're taking a lot of risks, and they're doing well. And they know that if things were not to go well, they get some more TARP money. And Geithner was on the Hill today, basically saying we got plenty more TARP money, and we may spend it. He wouldn't really be caged in, but Peter was talking with Alan Blinder and James Bullard in a debate about a week and a half ago. These are two current and former Fed officials, and they were very explicit about the fact that there's going to be much more active designation of which companies are too big to fail and which companies aren't, and what kind of regulations the too big to fail companies are going to get. And they say they're going to be very strict and they're going to be tough, and that if these companies are too big to fail, they're going to get an extra level of scrutiny. Well, if they're too big to fail, everybody's going to know that, and the market themselves will not force any discipline on those companies. They'll continue to loan them money because it'll be a risk-free bet. Give money to B of A, let them do whatever the hell they want with it, and if it works out, great. If it doesn't work out, it's okay. We're not going to worry about it. We'll get paid back. Smaller companies that might be more responsible, more intelligent, more prudent, are not going to have those advantages, and they won't get the money. So essentially, if you make these companies too big to fail, you're simply going to entrench mediocrity. You're going to entrench a culture of kind of like you'll be entrench failure and entrench dependency on the government to come and rescue them. So although you're seeing they're going to spin it now that this is an example of success. B of A was able to survive, turn around, and repay the government. Don't be fooled by this 12 months. Anyway, moving on. Also, interesting thing. This is the first I've ever seen of this. Obama mentioned today, and everyone's talking about the Jobs Summit and his Afghanistan proposals from West Point last night, which were another example of Obama trying to split the mean and perhaps pleasing no one by trying to give everything to everybody. But one small thing that was mentioned today that slipped through is that they're proposing that raising the FHA down payment requirement to perhaps 5% on FHA loans. Right now, the FHA requirement is 3.5%, which you can mostly get back through tax credits. So they actually, Obama administration said, in order to put homeowners more skin in the game, lower the default risks, perhaps we should increase down payments to 5%, which obviously we think is a good idea. We don't think 5% is enough. But, that's the first time we've actually seen the administration try to tighten on lending standards since they've been in office. Perhaps they understand that there is a lot of risk when people don't put any money down. So that's a good sign. And also, they're getting ready for the Jobs Summit. And I'm taking a look at some of the proposals that are going to probably be discussed. Of course, this is Obama's going to try to get the best minds together and figure out why it is that people aren't employed. And by the way, with the 17.5% underemployment figure, which is the highest since the Second World War by about 4 percentage points, and this is underemployment, so it's the 10.2% unemployed, plus all the people who work part-time, who would rather work full-time, or who have given up working altogether. These are truly historic numbers. And, of course, they're inviting all the best minds in academia and in labor and a couple of token businessmen to Washington to discuss, what we can do about it. And the basic ideas that I've seen, I haven't really seen anything that's going to be that I would consider a good job growth tactic, which I would consider to be lower regulation, perhaps cutting taxes, cutting regulation, credits, things that would be lowering the barrier to trade, those kind of things. Instead, we're talking about things like work sharing. We're talking about which is where you split one job and give it to two people, which I think creates a lot of inefficiency. We're talking about a jobs corps, like a New Deal type jobs corps, and then greater aids to states, give more money to states and municipalities so they can continue to, not have to cut back on their payrolls. none of these things will actually create jobs. They may delay greater gains in unemployment, but only saddle us with more debt, which is all we've been doing anyway. So that starts tomorrow, and we'll see how that plays out. Another interesting tidbit from today, it was released that 25.6% of U.S. households don't have bank accounts. That's kind of a staggering figure. A quarter of American households, there's about 100 million American households, don't have bank accounts. And these are people that generally get by using payday loans, those payday loan type of organizations. I still can't figure out why anyone would want to do that, given the fees that these places charge. And I know they're egregious. As a guy who always had a bank account, I don't understand why anybody wouldn't want one. Whatever fees they're going to charge aren't going to be as much as the payday loan people are going to charge. A lot of people who don't have bank accounts do have jobs, so I don't quite understand it. But when you think about 25% of our population doesn't even have a bank account, kind of puts things into perspective and kind of shows that we're not doing that well economically, and we're kind of slipping into quasi-third world status. Another interesting little news item of the day, Bernie Sanders, the independent congressman and the senator from Vermont, who was probably one of those liberal members of the Senate, he's going to block or at least delay the renomination of Ben Bernanke to Fed chairman, which will be up in January of 2010, without anybody putting a vote to try to put it up for reconsideration. They would have been able to bring it to a vote with just 50 senators. With him saying he wanted to block that, it's going to put a big delay in that and help to get 60 senators to move to a vote. And I think it's interesting that the only guy who's willing to do that is the guy who's so far to the left that he thinks that all Bernanke is a tool of Wall Street. We think there's of all the Republicans in the Senate, everyone's fine with Ben Bernanke except for Bernie Sanders. So another indication why we need someone with a little bit more economic knowledge in the Senate. Wink, wink, nudge, nudge. Say no more. The last item of the day that I'll mention is Australia. Australia, Mike, they have indicated that they're going to most likely raise their overnight interest rates to 4% in February. I think it's at 3.75 now. And 4%, I mean, that seems like, 1,000,000% to us, and, who are still stuck at zero. And it just shows you, I mean, obviously the Aussie dollar's had a great run. A lot of other currencies have had great runs. But the difference between 4% and 0% is huge. And their economy is relatively healthy. They have a pretty good balance of trade. They don't have the unemployment problems we have. And you can invest money in government bonds there and get close to a 4% yield. That's the reality that's driving a lot of except in addition to the debasement of the currency, the fact that if anyone has any money, why would you invest it here when you can get at 0% in a falling currency when you can invest it someplace else at 4% in a rising currency? And actually, just as an anecdote, I was in a bank yesterday, and I was in a couple of banks yesterday, and I noticed the signs for the mortgage rates. Remember when you went to the bank, you used to see, you walk in, they'd advertise their savings rates. They'd say 5%. Our passbook savings account, or they would change every week, and the banks would always put their rates in the window, their savings rates, and their CD rates. Do you see that anymore? You don't see it anywhere. I haven't seen it for years, but what you do see is their mortgage rates. So we've gone from a place in which they always advertise their savings rates to advertising their mortgage rates, and we don't really need to know much more besides that to know where we are. Anyway. So let's go to the phones. Let's start. Who's going to hit? It's Ellen from New York is waiting the longest. Oh, Ellen, how you doing?
Oh, good, thank you. Good.
Thanks for calling.
I have a quick question. I have a Euro-Pacific account. I actually met you in New York some months ago. Mm-hmm. And I'm wondering if you could explain to me why I cannot set stops underneath my stocks, my foreign stocks. Is that an issue?
Well, because it's not really up to us. We use a clearing firm called Pershing, and we can. The way it's set up with the stocks on the foreign exchanges, since it's cleared through Pershing, they don't have a system where they can set stops on foreign stocks. We can set stops on the ADRs, and we can set stops on any U.S. stocks that you own. But right now, it's one of the things we're not happy about. Because it's amazing that buying stocks on foreign exchanges is not a typical way that U.S. brokerage firms do business. It should be, but it isn't. So, we're looking at that, and we're looking, certainly talking with them, and perhaps, someday it'll change, whether it's through Pershing or another firm.
What is their reason for not doing it? Do they have a reason?
I don't know. I don't know. I've tried it for a couple of my clients, and it's not possible for those stocks. They just don't. They're a very big firm. We're not a very big firm. They're not particularly responsive to what we're asking for. They don't want to change their systems for a small firm. So Peter's not a big believer in stocks. I mean, if you would have stopped out of your stocks in 2008 when things were looking really, really bad, you would have paid a serious price because we suffered a lot of losses in 2008, and a lot of stocks, precious metal mining stocks, Asian stocks got killed, but then they came rallying back.
So I opened an account with you last December, so I've done very well. But
you've done. You haven't dealt with that.
Yes,
you haven't dealt with that.
I just feel comfortable if a stock is up 50%, I'd like to set a stop 25% below, just in case we have some massive correction.
Well, unfortunately, we don't have that.
I know.
What I can do is, you can, do you have online access to your account?
Oh, yeah.
Okay, so you're looking at your account. You can see, and how many stocks do you have?
Oh, do I have the account up now? I don't have the account up now.
No, approximately. I mean, if you have 10 stocks, 15 stocks.
Yeah.
Keep an eye on them. And if you get nervous and you really want to lock in, first of all, if you want to sell, I would pay close attention to your tax position. I would see if you're going to sell, or you're going to generate a short-term capital gain. Do you have a short-term capital loss to offset that?
Yeah. Fortunately, it's an IRA account I have with you, so that's
if it's an IRA account, you don't have to worry.
Right.
But just an example, we had a stock that was way up, and I had a couple of people that were nervous about it. This is Skyworth. I'm sure you perhaps heard of it.
Oh, yes, I know that one.
Maybe you're lucky enough to have
shares of it here or there. Mm-hmm.
And look, I had some people that wanted to take profits, and I had some people who I thought I felt duty bound to mention it to them. Look, the thing's way up.
It is.
What do you want to do? Some of them said, okay, let's sell part of it, and some of them said no. Some of them sold all. Not many. One or two sold all of it. Now it's about a month ago. It's doubled since then.
I know. I'm selling part of it as we've gone along, but I still have some of it, and I look at it, and it's just honestly, it's a little bit terrifying. It's up so much. It is.
I mean, they're actually announcing earnings tomorrow, so it's either going to be up again, big time, or it'll come down. But if it does, you got to ask yourself. You can never kick yourself if you leave money on the table. You got to promise yourself you're not going to kick yourself if it keeps on going up, but you just got to make a determination of where you want to be, and whether you're okay with that. Or once the thing starts rolling, it's got a lot of momentum. So it's very hard to say. What I would say is, like, if you keep an eye on your stocks. If you see now, I definitely think there could be a correction out there, whether it's 10%, 20%.
Right.
But one way to do it is to pick a couple of stocks that maybe you think are great or have done very well, and if things go bad, sell those, but don't sell your whole position. Now you sell, if you think things are doing terribly and you want to protect some of those assets, a couple of sells, and then you'll know that if things went badly, you've got some more dry powder, and then you can wait and buy more on the dip, which is what the people that did the best thing here, the people that bought in that dip in late 2008. So
right.
If it goes down 20%, you want a little peace of mind. I mean, Peter will tell you that, stick to your guns. That works for him. Other people don't have that kind of intestinal fortitude. If you want to, hedge your bets, which you normally do through stocks, which we can't do here, things start falling back. Maybe sell 20 or 30% of what you got. Keep that powder dry. If you mistimed it, maybe you'd want to rebalance those assets anyway, so now you'll buy into positions a little more evenly. And if not, you've got some dry powder to make some more purchases.
Right. Well, maybe in the future you'll have a different clearinghouse. They'll be a little more cooperative.
Perhaps.
Okay.
You never know.
Thanks, Andrew.
Thanks for the call, Alan. Okay, let's go with Christina in Washington.
Yeah. Hi.
Hi, Christina. How you doing?
Good.
Yes, I can.
You can hear me?
Yes, I can.
Okay. I just have a question about Austrian economics. I don't quite understand. Peter talks a lot about how manufacturing is very important for any economy to have, but it seems to me like you do have certain economies, like in Singapore and Hong Kong, that are very service industry based, and I think he would agree that those are very healthy economies. That those two countries are anomalies.
Well, you can in a completely international world where there is free trade, and you can get access to someone else's production. It certainly is possible that you could have a service sector economy as long as the services that you're selling, if you can pay for all the things you're importing, because if it's a service sector economy, you're not making anything inside your own economy, and basically you need to be able to produce things. I mean, the history of economics, and we're actually, Peter and I are working on a book about this. It's going to come out, a cartoon book. It's going to come out in April and May of next year. You have to be able to produce things. The more you can produce with a small amount of input meaning if I could go and snap my fingers and produce any amount of goods in the world, as much as we want, or huge amounts of, then everyone can use those goods, and people wouldn't have to work for it. So you wouldn't have to work. You'd have all these things that you want. You want it, but it's difficult to make things. So you have to work to make them, and the easier it is, the more efficient you become in making them. The more goods you can produce for a given amount of input, the wealthier you are because you have more things. Now, in a service center economy, in services, you're not producing anything. You're providing a service. But if you can trade those services for some things that people produce and pay for them in kind through those services, and you can maybe do it on a balanced basis or even maybe have a surplus, then sure, you can have that kind of economy. The problem with our service sector economy is we run huge deficits. We don't pay for the things that we get with services. We're not exporting enough movies or exporting enough consulting expertise or financial expertise to pay for the real goods and services that we're importing, because we're running huge deficits.
Okay. I understand. Yeah, I understand better now.
With Austrian economics, it's nice if you talk with a thick Austrian accent. That's what it really means. Just kidding. But look for this book. It's going to be an illustrated cartoon book. We're going to go to press with it in about a month. So it's going to be very funny, and hopefully it'll get some. We haven't really titled yet. We're not sure, but it'll be out soon. But thanks for your call.
All right, thank you.
Mike in Ohio. Mike, how's it going? We'll be with Carlos in Indiana next. But how you doing, Mike?
Okay, sir. Hey, I had two quick questions. This one here, I'm not even sure if you know. I trust your guys' opinions on certain, analysis groups or things like that. Are you familiar with Graham Summers?
No, I'm not.
He's an editor of Gains, Pains, and Capital.
Gains, Pains, and Capital. I have to beg ignorance on this one.
Okay, because I was just wondering if you guys were familiar. What he was writing about is that he feels that, or doesn't feel, just from the short positions that Goldman Sachs has in the financials, that they're betting that this whole financial crisis is not over with either. And he goes on to list the different, banks and MasterCard, Wells Fargo, PNC, AIG, and all their short positions that they have. Now, I don't know how he gets this information. I don't know if that's public to everybody or what.
What is it information that he doesn't think, the information that he didn't think the financial crisis is over? There's a lot of people that share that view.
Exactly. But what he's saying is Goldman Sachs doesn't believe it either because of all these short positions in, the QQQ and the
Well, if you were Goldman Sachs, and you had just lived through 2008, don't you think that you would have some kind of hedges on whatever investments that you have? And of course, Goldman Sachs has made an incredible amount of money this past year because they're borrowing money at 0%, and they're doing all kinds of things with it and making huge profits. But still, they're smart people. They know that they got bitten once, they can get bitten again.
Right.
And that if so they're going to they got a lot of hedges out there. And of course, there shouldn't be any news that they do have hedges.
To show that even Goldman knows that the problems that could still be, coming down the pike here,
Oh, absolutely. Absolutely. Yeah, I mean, obviously we think that there's the bubble right now that we're blowing up. I mean, it was a debt bubble. It was in 2007, 2008. It was a mortgage debt bubble. Mm-hmm. Now we're blowing up a U.S. government debt bubble because all debt is becoming Treasury debt because the government has now taken over and bailed out so many companies that all these kind of different classes of bad debt have become government debt. So we're blowing up a bubble. We're running these huge deficits, requiring the rest of the world to buy those bonds, and they're way overpriced because they're yielding nothing. Of course, in bonds parlance, yield is a low yield is equatable to a high price. So they're high priced, they've got no value, and everybody's buying them for all the wrong reason. It's a bubble, and when that bubble breaks, when the sovereign debt bubble breaks, it's going to bring down a lot of firms. We happen to think, the thing about the difference between now and last year is that when things went haywire last year, nobody knew who had the exposure to the bad debt because all the securitized debt was so diffuse and amorphous. There's a lot more clarity now about where the bad debt is. So, when the next, we're still stuck in this loop where the dollar falls and the stocks rise. And everyone assumes that when stocks fall, the dollar's going to rise like it did last year. Mm-hmm. And I think it might do that, but it might not do that to anywhere near the extent as it did last year, because last year was mostly driven by fear and panic because nobody knew where the losses were. And I think now that there's a little more clarity, and plus there's a lot less confidence in the dollar this year than there was last year.
Right. He just thought that it was ironic, though, that Goldman, who has $40 billion in derivatives versus $119 billion in assets. Actually, it's the other way. There's a huge difference.
Yeah, I mean, the derivatives market is still something that mystifies me and mystifies most people.
Yeah.
And they're going to try to regulate that. There was some movement yesterday on that front. I didn't really read all the news, but
yeah,
there's like one person in the world that understands it.
Right. And then I was wondering also if there was a run of gold and the Federal Reserve, like if Germany, Hong Kong, or members of OPEC were to actually start to remove their gold from the Fed or the Bank of England, is that possible?
Well, they all have their own gold reserves. I don't think that they need to remove it from the Fed. I don't think there's any reason to do that. But they definitely are all trying to accumulate now. There aren't too many people that I've heard of that are looking to sell their gold. So, I've never heard of anyone trying to get it from the Fed. I don't think the Fed has a much lower percentage of total gold reserves now than it has in the past.
But didn't they actually put their gold into our reserves just for safe holdings, years ago, and they never did take it out?
Years ago, yeah, they did back before the war. But I don't know, the world has changed since then, so I really don't know much about that. Anyway, I should go to Carlos in Indiana, who's been holding for next to 40 minutes.
Okay,
Carlos.
Thanks, Andrew.
No problem. Carlos. And by the way, Carlos, you there?
I'm here, Andrew.
Good. Thanks for holding so long. We've got a couple of open lines left for the end of the hour, so if you want to call in, give us a shout at 888-678-9597. That's 888-678-9597 to call into Wall Street Unspun. Okay, Carlos, go ahead.
Hi, Andrew. Now, I know you and your brother are very bullish on China, Singapore, mm-hmm. Hong Kong, etc. I haven't heard them talk much about India, though. They do have over 1 billion people. They say they work hard, and mm-hmm. They have a common law system just like we do. And it mm-hmm. seems like they should be getting a little bit more play on.
They really should. And the fact that we don't talk about them much is mostly because we can't really buy the market. India's got some very strange securities laws, and basically foreigners can't buy stock in India. The only stocks you can buy are the ADRs, and there's a couple of ADRs that we buy. I have a lot of my clients in Tata Motors, for example. That's the manufacturer it's the biggest car manufacturer in India. I know the people that make those little $2,500
car.
Yeah, and it's like I think a lot of kids in the United States have cars. 5-year-olds have cars that are worth more than $2,500. But they also, in addition to making that, they want to sell that car all throughout Asia. makes a lot of sense. They also do buses, and, people in Asia, they use a lot of buses. They build highways, they build farm equipment, all kinds of stuff. So there's a couple of the Tata, which is also the steel company that's listed as an ADR. There's a few other companies out there that are listed, but you can't buy the small companies that you can, like for other markets like Australia and Singapore and Hong Kong. So it's unfortunate. I think there's probably going to be some liberalization of those laws going forward. I do, and if they are, we'll probably try to get more analysis of India. Historically, we've been a company that's always been involved in the more mature markets, the less volatile markets, and I think India was a little bit outside of that general bias. But I think everyone understands that India is a big player now, and it's got some much more mature and developed countries. And frankly, I'm more comfortable with their political structure than China. I mean, obviously, India is a democracy. India, I think, is a lot more, with the exception of their ethnic problem, the religious problem between Hindus and Muslims. They're a functioning democracy, whereas China is not, and they have as a state in which people don't have the right to protest or really even speak their mind. They are more susceptible to regime change. It doesn't take much in that kind of a tinderbox, that kind of situation for destabilization to come up. And I think that the Chinese are that's why they're so reluctant to make any changes. I mean, why they wouldn't want to revalue their currency upward? I mean, it defies logic. And I think they're just so reluctant to change the course of where they're going for fear of disruption and for fear of civil unrest.
I will, long term, 25, 30 plus years from now, I do see a demographic problem in China. There's quite a few young men who just don't have the whys because of the hard-headed one-child policy. India doesn't suffer from that. So, very long term, I do see that benefit to India.
Yeah, and I do see also, from what I understand, China is a much more transient society where people have been uprooted and people are losing touch with who they are and where they've come from. And this is on a sociological level. So in that kind of, you have a potential for more instability, whereas in India, believe it or not, the traditional ties are still there, even though they are moving into a more modern economy. I mean, you don't see any of the superlatives that you see in China, with this huge, new cities sprouting up left, right, and center. The infrastructure projects are huge. You don't see that in India, but I think there is certainly a lot of opportunity there.
Absolutely, Andrew. I appreciate it.
Okay, no problem. Nice talking to you. Let's go to Susan in California.
Hi.
Hello, Susan.
I've been recommended to the show by my son.
Okay.
And I'm happy you're taking my call. I was just
Is this your first time listening into the show?
Excuse me?
Is this your first time listening to the show?
Yes, it is. He's been telling me a lot about the show.
Normally it's not me. Normally it's my brother, who's so much better. No,
that's what my son is IMing me. But he didn't say your son is better.
Is he saying too bad it's not Peter?
He didn't say that.
Okay. Okay, well, I'm glad you're a listener. We're here every Wednesday, rain or shine, at 8 Eastern, 5 Pacific.
Great. He's been recommending me to get gold, which I'm fine with, and my concern is, well, maybe I should just get rid of my house too, and just buy gold. What do you think?
Well, make a little tent out of the gold. I mean, well, it depends.
No, buy a smaller house.
Well, this is the thing. I mean, Peter, this is the decision you got to make. Peter does think that the real estate, and I think that real estate's not going to show any significant gains going forward. We might see gains in real estate, but only as a function of the dollar falling. But real estate, as far as we're concerned, is still overvalued. Not as overvalued as it was before, but there's really no reason. There's no big forces that are going to drive up the price of real estate in the coming years. So if you have a house that you live in, and if you want to live there, you got to figure, well, it's my quality of life. This is my house. I love living here. I want to stay here. It's not worth. There's a dollar value there, or even a gold value there. If your house is simply a place for you to live, and you can sell the house and rent the house next door for the same amount of money, or even less, and cash out and take a big chunk of money out off the table, and you're fine with that. and you very well may be. Well, then you've got to figure out, is my money better stuck in this house, or am I better putting it in gold or other investments? Now, if you make that determination, if you say, you know what, I can live across the street, doesn't bother me, or maybe I want to move closer someplace else, I'll be fine there. Then sell the house. I don't think you're leaving. It's not going to be worth more in a couple of years. Maybe even it's worth 5 or 10% more if you're lucky. I mean, how much more is the gold that you would have been able to sort of extract out of it going to be worth at that point? So if that's the decision you can make, there's a lot of things you can do with your money. If your money's locked up in real estate, then you can't get it out of the dollar, and you can't do anything with it. But the first question you got to ask is, where do I want to live? And don't forget that the quality of life has a dollar value, and that's a question that only you can answer.
Are you based in California?
No, I used to live in California many years ago. I lived in California from up until 1991, from 80 to 91. But now I live in New York City. I live in Brooklyn, and I work at the New York City office.
Okay,
so we do have two very competent offices. Where do you live?
In South Pasadena.
South Pasadena. Well, we have an office in Brentwood.
Okay.
And you're run by a very competent manager named Heyman Kathuria. He's got actually our biggest office is in Brentwood. They've got 12 brokers there. You can look it up on our website. I would suggest giving them a call and maybe coming in. Pasadena, you're talking about 30 minutes. Mm-hmm. I don't know what LA traffic's like these days. And I would recommend doing that. We also have an office in Orange County that's a lot farther for you.
All right.
Call up Heyman and tell him Andrew sent you.
Andrew?
That's me.
Okay.
I'm just kidding. And I'll give you a free. Tell him Andrew sent you, and you get a free, Euro Pacific mouse pad. Now that we don't give away mouse pads.
I was hoping for free gold.
Well, we're trying to start we have different ways of buying gold here. We mostly sell gold through gold mining stocks, through the gold ETFs. We also represent this Perth Mint certificate program, which is a great way to buy and own gold. It's through the Perth Mint in Australia. You can own the gold with no storage fee, but it's unallocated gold. It's not like owning the physical gold in your house or in the safe deposit box, but it's a good middle ground. Or we're even looking to start a coin company in which you can buy gold through your separate company that your Pacific is going to own. But give them a call. Anyway, I should move along. Thanks for the call, Susan. And let's go to Brian, Connecticut. Hello, Brian.
Hi, sorry, a little technical difficulties with my cell phone here.
No problem. So, Brian in Connecticut, you're probably taking a moment out of your busy Vote for Peter Schiff campaign in Connecticut. You're calling to the show. Is that correct?
Yeah, I'm actually really curious and waiting to see what you guys have in store for us, those of us who want to help out.
Well, I'm not on the. I used to work in the campaign. Now I work for Euro Pacific Capital. When I worked in the campaign, there wasn't really a campaign. But I am privy to what's going on there, and I do know that we're planning on doing a lot more. Look, in the month of December, we plan to hit the airwaves, do some other little some kind of events that we think are going to attract a lot of attention. We clearly need to get Peter's name out there. Two of the other Senate candidates have dropped out of the race. So now it's a three-person race. Just 2 more people need to drop out, and Peter's got the nomination wrapped up. But it's tough. The other two that dropped out have been really scared off about the money that Linda McMahon is going to throw around. And for those of you who don't know, Linda McMahon is the wife of Vince McMahon, who owns the World Wrestling Federation. And they've got $200 million, and they've pledged a lot of money to get her elected into the Senate. She's a Republican. She doesn't have much in the way of policies or a platform or any kind of understanding of economics the way Peter does, but she's got a lot of money. So, but I know people are frustrated. They want to see some more action, and there are definitely things coming down the pipe, and we hope to really make up some ground. So anyway, you have a question?
Yeah.
What can you do? Is that the question?
Well, no. I'm sure I'll find that one out as the campaign starts to unfold.
Well, go to Schiff for Senate and sign up as a volunteer at the Schiff for Senate website.
Yeah, I've done that already. I'm
okay.
I'm chomping at the bit to get on board.
Okay,
and help.
Anyway, do you have another question? So one more caller I want to get to before we run out of time here.
Yeah, real quick question. I'm reading Economics in One Lesson by Henry Hazlitt. In the book, he references, he talks a lot about tariffs and how they're generally bad, but he does reference some tariffs can be good. I'm wondering if you can give me an example of a good tariff. I can't think of anything off the top of my head.
No, I don't think so. I mean, tariffs, I don't know what he's referring to. I mean, tariffs are bad because you want to be able to access anyone's comparative advantage. If one place in the world has got a comparative advantage to make one type of product, it benefits everybody on the planet to buy that product from the place that has a comparative advantage, because that means you have to spend less output on your own producing that same product. So everyone should be able to produce those things that they're best at and they have the comparative advantage to do, and therefore everyone will be better. Tariffs are always by nature going to be arbitrary. Someone's going to make a political decision. This is what we want to protect, and someone's going to pay a higher price for the thing that's being protected, and then of course you're losing some efficiency. So as far as I know, there aren't any good tariffs. But I'll research it. I think we've got a copy of the book in the office in place, and I'll take a look at it. Anyway, let's go to thanks for the call, Brian. Let's go to Cynthia in Pennsylvania. We've got a couple more minutes left. Cynthia, how you doing?
Hi, how are you? I'm first-time caller, so if I seem a little nervous, you'll know why. I have a question about proof gold. And
about what gold? First gold?
Proof gold. Proof gold.
Proof.
First
okay.
minted proof gold.
Yes.
You know what I mean?
Not really.
No. Oh, okay. Well, we turned our gold, our RAA into half gold. And this one company, they said that we should buy proof gold, that it always performed better than the bullion.
I think perhaps what they're talking about as opposed to numismatics. I mean, there's two kinds of coins when you can buy gold. And when you buy gold, you can either buy, there are certain types of coins, maybe I'm not familiar with the term, maybe proof gold is simply what's considered to be commodified gold, which are things like South African Krugerrands, Canadian maple leafs, American gold eagles. These are just simply coins that are minted and they're have a very high, they're 98% pure gold, and they're they're not sold for their collector's value. They're just sold as a commodity. On the other side of the other side of the coin, no pun intended, are numismatic gold, which are gold. Could be an 1875 this or that, or a Liechtenstein this, or a Great Britain. And these are gold, the coins that had limited quantities of. They're collector's items. They have some value in addition to their gold content.
No,
and
that's not.
A lot of
I'm sorry. Go ahead.
Okay. So other than proof gold, I think then among the real gold you have gold coins and you have bullion, which could be bars or bullion bars, big bars, small bars. So I don't know just what proof gold, what they're talking about.
Well, from what I understood, it was the first minted proof gold, and apparently
proof sets. Proof sets are like, okay, then that's another collector's thing. A proof set is, then it comes in a set, and it's like it's more documentation of where it came from. But that's almost only associated with numismatic coins. That means you get a complete set.
I guess I'll have to catch you next week, right?
Yeah. Well, I'll hopefully I'll tell you what. If you send me an email at aschiff@europac.net, ASCHIFF@europac.net, so I have your email address. I'll take that request, send it around here. I'm sure somebody knows it, and I'll send you a response.
Oh, great! Thank you very much.
Okay. So we're running out of time here. Thanks for everyone for calling in and listening. I'm sure Pete will be back next week with all the latest in doom and gloom, just in time for Christmas. No, just kidding. He'll be cheerful and bright. That's about it. Wishing you good night from New York City. This is Andrew Schiff, and you've been listening to Wall Street Unspun. Thanks a lot. Are they going to count me down? No, they're not going to count me down. Anyway, give us a call. Take a look at our website at www.europac.net. It's EUROPAC.net. And give us a call if you're interested in investing outside the dollar or overseas. Okay, thanks a lot. Bye-bye.